Hello everyone, this is Nick Lump. It's Friday, January 24th, and a quick thanks to everyone who participated in the survey so far. And I got a question about wanting to know, a little bit more moving forward about some of the events that are driving markets. For example, why was the stock market down yesterday and it looks like we'll be down again today? So I wanted to do a quick video here to talk about this more in the longer term picture, and then I'll zoom in and show things just over the past few weeks to show you how we pretty much had an indication that stocks were about to fall. And I know this is kind of tough to see, but what this shows, these are 6 charts over the last about 9 or 10 months. And don't worry about kind of zooming in just yet, just look at the big picture. So up here in the top left, we have the S&P 500, so this will be our gauge for US stocks. In the top middle, this is the US 30-year Treasury bond. Up here in the top right is gold. This is the Japanese yen, the Australian dollar, and the Canadian dollar. And what we can see looking over the past few months is certain trends, and this is what I talk about when I say capital flows, which is really, where is the investment money going? What is it going into? What is it coming out of? And that will give an indication of almost the attitude of the market. And what you tend to see is that the attitude can change very quickly, and oftentimes, can happen at the start of a new year, which is kind of what we had, because you'll have big fund managers and so on. They're repositioning and reallocating. But let's take a look at what's been going on. So we'll look at bonds first. And after they cracked last spring, they've been moving very in line with economic data now, meaning when the economy improves, bonds are falling, because people are willing to take more risk in their investments, and when the economy slows, bonds have been rallying. So right here, gold has been moving with bonds. Now gold is an interesting, we'll say, beast, because it can change how it moves. Sometimes it moves with commodities, sometimes it moves as a currency and against the dollar. Other times it moves against economic uncertainty, and that's what happened for about the past 2 years. Gold has flipped and now moves opposite of the economy. So that's why this chart in general looks just like the bonds. It falls during economic improvements, and now it's been recovering when the economy starts to slow. Down here, the Japanese yen has been falling mainly because of their policies that they're implementing. They're trying to purposely devalue the yen. But the important thing of why we look at the yen is because it is known as the carry trade, which means people will borrow in yen because it's very short interest rates, and then use that money to invest elsewhere. And so what you tend to see is the yen will move in the opposite direction of whatever market is doing well, like the stock market, for example. And then the last two, the Australian dollar and Canadian dollar, these two are very closely tied to the global economy, and very sensitive, because their economies are based largely on commodities. So when, for example, China is booming and there's a lot of demand for commodities, these currencies and these economies will do well. Now they've been moving kind of in line with things as well. Now largely though, because China has been slowing, you've seen both of these get hit pretty hard. So let's zoom in now and just look at things over the past few weeks. And what we can see is there was almost an indication that the market was going to fall, because since the start of the year, we had Treasury bonds were rallying, gold was rallying. With both these are indications that the economy, might be getting a little bumpy here. The yen was rallying, which means money is going into the yen, into bonds, into gold. It has to come out of somewhere. Now both the Australian dollar and Canadian dollar tipped over and were falling. This again was because of some slowing economic data. All 5 of these were pointing to what should say that the stock market will fall. Now what happened was we've been moving sideways here because we've been in a strong trend, but sooner or later, the stock market needs to catch up. And it's usually one of the last markets to move. So while we've had basically this sign that money was going into these other asset classes, it was saying that it should be coming out of stocks. And then all we needed was some piece of news that just kind of sets off the trigger. And so really the market isn't falling because of that news. Despite the media, they'll come on and say, well, stocks are down today because there was a bad report out of China Wednesday night, that's not necessarily what sent stocks lower. They were, you could tell that they were going to move lower. They just needed some piece of news or some event to trigger it. And so in the short term, really, this is something that you could see coming. And I think that for the most part, we were pretty oversold in a lot of these, like bonds and gold. And you hit a point where you're just kind of due to bounce back. Again, as people are reallocating large portfolios and so on, money's going to start coming into these assets that got knocked down. So we'll see how far this runs. I'm not very concerned about this in terms of the stock market. We certainly could move lower here. I mean, we're still very close to the highs, but this is for the most part just the cyclical, the ups and downs of markets as money comes in and out, and nothing too alarming just yet.